Which data points matter most in commodity fundamental analysis? Imagine trying to predict the next big move in commodity prices. It's like solving a puzzle with many pieces. Some pieces matter more than others, and knowing which ones can make all the difference. Today, we're going to uncover the most important data points that influence commodity prices and how you can use them to your advantage. First, let's talk about supply factors. The amount of a commodity produced is a key piece. For example, if crop yields are lower than expected or oil production drops, it can tighten supply and push prices higher. Keeping an eye on current and forecasted production levels helps you see where the market might be headed. Inventory or stock levels are another vital point. Large reserves can indicate surplus, which tends to lower prices, while low inventories suggest scarcity, often leading to price increases. Weather conditions are especially critical for agricultural commodities. A drought or flood can drastically reduce yields, impacting supply and prices. Transportation capacity and costs also play a role. If it becomes more expensive or difficult to move commodities, supply can tighten, affecting prices. Government policies like subsidies, tariffs, or export restrictions can either boost or limit supply, making these policies important data points to watch. Moving on to demand factors, consumption rates tell us how much of a commodity is being used. If industries or countries ramp up usage, prices can climb. Seasonal trends matter too. Heating oil demand rises in winter, while agricultural demand peaks during harvest seasons. Economic indicators like gross domestic product growth or industrial activity give clues about future demand. When economies grow, demand for commodities usually increases. Currency exchange rates are also influential. A weaker domestic currency makes exports cheaper for foreign buyers, boosting demand. Geopolitical events such as trade agreements or conflicts can disrupt supply chains or alter demand patterns, so they are essential to monitor. Market and macroeconomic factors add another layer. Global trade flows reveal shifts in supply and demand across countries. Interest rates influence how much it costs to finance commodity investments. If interest rates rise, it can slow down demand for commodities as borrowing becomes more expensive. Since many commodities are priced in United States dollars, fluctuations in the dollar's strength directly impact prices. Unexpected events like natural disasters or political unrest can suddenly change supply or demand, making it vital to stay alert to news. Finally, there are official reports and data sources. Commodity balance sheets give a snapshot of supply, demand, and stock changes worldwide. Reports like the World Agricultural Supply and Demand Estimates provide detailed forecasts. Commitments of traders' reports show how different market players are positioned, helping you gauge market sentiment. Using these data points together allows investors to spot potential shortages or surpluses early. They help you understand whether current prices reflected real market conditions or are driven by speculation. Combining this fundamental data with technical analysis can improve your timing when buying or selling commodities. In the end, the most important data points are those that reveal changes in supply and demand. Production levels, inventories, consumption, weather, economic indicators, geopolitical events, and currency movements all work together to shape commodity prices. Knowing which ones matter most helps you make smarter decisions and better understand the market's future direction.